Well, global stock markets plunged today over fears of a weakening U.S. economy after job growth slowed sharply in July. The Japanese market led the sell-off, having its worst day in nearly 40 years. Wall Street also took a beating. All three major indices plunged more than 2.5%. So what does this global sell-off mean for Canadians? Well, joining me now to discuss this further, Earl Davis. Earl is the head of fixed income and money markets at BMO Global Asset Management. Earl, really appreciate you giving me your time today.
A pleasure being here.
So, I mean, when we see what happens here and we see the numbers drop and we see what's happening in the U.S. economy, break it down for us if you can in terms of what these numbers translate to.
Yeah, what we've seen are significant losses in stock markets. So if we look in North America, Canada and U.S., over the past week, we've lost about almost 10%, call it 8% of equity value. But what's accelerating the move are the moves that are actually happening in Japan. Since August 1st, the Nikkei has lost 20%. And because the global economy is all connected, it impacts North American markets as well.
So let's break that down a little further in terms of what we see that's happening in Japan, but Canadians are watching it as well. Let's start in Canada first. What the impact could be, what should we be concerned about?
Well, I'd say actually being in Canada, it's the best of all markets to be in.
Okay.
The reason is we don't have a lot of tech. When you look in the U.S. and the big sell-off, it's happening in the tech, your NASDAQs, your S&Ps. But your other equity indices, the ones that represent your small and medium-sized businesses, your Russell 2000s and the like, they're still coming off, but they're doing all right. And the reason why they're doing all right goes back to the source of the volatility we're seeing in North America. On Friday, the U.S. employment number came out much weaker than expected. The unemployment rate went higher, jumped a little bit. Jobs produced was much lower than expected. And that triggered the market participants thinking, oh no, the Fed Powell has been speaking about jobs.
Right.
Now we're seeing a reduction in jobs. Are we going to have a hard landing? And a hard landing means a recession and higher rates, so it's the worst of all worlds. From our seat as professional investors, we feel confident in the market. So things should be all right in Canada.
Picking up on just one thing that you said there, what about businesses that do business in the United States, that cross-border business? Does this affect things at all?
No, and I would argue it actually affects things for the better.
Okay.
So the reason why it doesn't affect things right now is that the U.S. economy is still doing well. Stock market down today, down 8% in the past 2 days. Doesn't mean the U.S. economy is doing less or worse by 8%. It's actually still producing jobs.
Okay.
It was a weaker job number, but it was still a positive jobs being 114,000 jobs being produced. So that's a good sign. The other good thing in both Canada and the U.S., I know this is a bit controversial, there's still a lot of fiscal spending. Fiscal spending is actually good for the economy. That's more money going to jobs, more money going into the economy. So that's a good thing. That's one of the reasons why, despite this volatility, we do not see a recession happening in Canada or the U.S. for the next 2 years.
So, having said that, we watch the numbers here, and I think a lot of Canadians trying to understand what those numbers mean. We now look to Tiff Macklem and say, okay, what is the Bank of Canada going to do? The rate dropped in the last round. Could we be seeing something similar as we wait now for their review on things?
Yeah. So there's two parts to that answer. One is, yes, definitely. I think this increases the probability that they will continue to ease rates or cut interest rates.
Okay.
At the beginning of the year, interest rates in Canada, overnight interest rates were at 5%. The Bank of Canada has cut twice, so it's now at 4.50. A lot of market participants are anticipating that bank rate to be 4% by the end of the year. Because of this volatility in the equity markets, we actually see it being at 3.75. So it actually reinforces them cutting rates. There's another aspect to this. This morning, with all the market volatility, there was the market was talking about possibly the U.S. cutting this week. Interim.
Right.
So actually, what that says is two things. One is there's a lot of dry powder in both Canada and U.S. to cut rates. We're at 4.5. 3 years ago, we were at 25 basis points, under 1%. Similar numbers in the U.S. If things get really bad, the central banks could come in and really cut rates. That's why we have confidence that, although we have volatility here, there's opportunities that are presenting itself. It's not, the sky is falling.
Right, the sky is not falling because we know, and we've seen this in the U.S., mortgage rates are going to fall. Is there going to be sort of that knee-jerk reaction? Well, we need to take a step back. We'll watch that, but we're also watching big tech as well. Is it a reaction or is there an actual effect here from what we're seeing?
I think there's an actual effect on big tech. And the reason why is it's not necessarily the markets, it's the Fed.
Okay.
So, given the unemployment number we saw last week, now market participants are saying, yes, the Fed is definitely going to ease or start the cutting cycle in September.
Right.
Once they start doing that, it benefits not big tech. They don't need the money. They don't need to borrow bonds because they have so much money coming in. But it benefits those small and medium-sized companies that have a lot of manufacturing, have a lot of capital expenditures.
Okay.
Now that's going to be cheaper for them. Because that's cheaper, they have more money to hire more people, buy more equipment. So it could impact negatively big tech. It's possible, but we would see a benefit in regards to other types of companies.
So now looking at where we're at now, and we use that word recovery, right, when we see sort of where the numbers go, what are you anticipating in terms of what this recovery is going to look like? You mentioned Japan as well, having been hit hard. So we're seeing on that global scale as sort of, I guess, Canada is watching from this side of the pond. What do you see in terms of recovery and what that's going to look like?
So I'll speak to the recovery as a step, but there was one thing we have to watch out for. Okay. So let me talk to recovery. Our base case or our expectation is that the volatility in the markets will calm down.
Okay.
It's not going to be immediate, but it's going to calm down. And this actually provides an opportunity to buy individual name stocks, to buy corporate bonds, to buy a number of things. I'm a fixed income guy, we especially like bonds. And the reason why we like bonds, when the equity markets have been selling off this past week, you know what's happened to fixed income? That's rallied.
Okay.
So if you have a diversified portfolio of bonds and stocks, you haven't done as bad as you may think you have done.
Okay.
So the one thing, however, to watch out for in the markets, what could accelerate the sell-off and the lack of confidence, is geopolitical risks.
Right.
If you see any reaction in the Middle East to what's happened recently, that will definitely have an impact on equity markets and risk, and we could see lower levels. Having said that, we would still view that as an opportunity to buy individual names, to buy fixed income. We still like the markets because we don't foresee that recession.
Few factors that we need to be keeping in check here, but I appreciate to have you here breaking down the numbers and sort of weeding us, getting us through the weeds on all of this, because it can be a little bit can be a little bit daunting. Earl, thank you so much for this. I really appreciate it. That's Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thank you again for this.
Thank you.